He also has a rich experience, advised various top-tier companies in relation to structuring, acquisitions, diligence, funding, etc. He has led several assignments ranging from corporate restructuring, investment structuring, exit planning, jurisdictional analysis, and succession planning. He also have enough detailed experience in dealing with FEMA matters, real estate matters, pharma, startups, fintech, and top-tier listed companies. Amithraj speaks regularly across various forums on tax and regulatory and valuation aspects, and he has addressed more than 100 seminars. He is also a visiting faculty in IIM Bangalore for corporate programs. Over to you, Amit, and thanks for being with us and delivering this topic. Over to you.
Change it. Yeah. Good afternoon, everyone. Thanks, AIFA, for this opportunity. I understand post-lunch session is the toughest, both for you and me. We'll try to keep it as interactive as possible. And again, I'll not bore you with too much of text in terms of reading, etc. So what I want to cover here is broadly, like anything to do with startup, it's a quick pace thing. Like what we were doing in startups like some 3 years before no longer sort of holds good as we speak. So the latest emerging trends, what they are, how people are going about, and there are various facets in our startup structuring, starting from the structure itself, like should it be a company, LLP, should I set it up in India or should I have a foreign holding company? Until recently, the trend used to be like all the companies used to go to either US or Singapore. But of late, what has happened is with the valuations in India being better for listed companies, we are working as a firm, a small firm of ours, we are working on some 7 or 8 projects where we are bringing the companies back from Singapore or US back into India so that you can do a listing in India. So it's a little counterintuitive sort of thing. So far we were sending out, market here is working better, so we are trying to bring the companies back in. So those are the things, and generally other thing that typically is happening off late or in the recent past around startups is, okay, the company does well, founders has already got, say, have got diluted to 20-25% stake. Usually the way they negotiate is, okay, I'll get the value of the company, say, from X to Y, or X to 2X or 3X, you give me some extra stake as incentive. So those are the other conversations that are going on, and few of us may be aware that ESOP cannot be given in the context of a founder who is holding more than 10% say, or who has ever been named as a promoter unless you're a registered startup. So those are the other things that are there in terms of what is the best way to sort of allocate the shares to founders, which have covered about 4 odd options. Again, in terms of the earlier structure, if I want to sort of leave India to externalize or flip the structure, what are the key parameters to be considered? Because the standard structure, what we used to do is simply somebody would set up the company and do the gift, which has now been blocked under the new OI regulations, overseas investment regulations that have come in. With that regulations in place, now within the purview of the law, what can be done? Those are the things I'm going to cover. And also we put like 2-3 models on the business model side of the startup. Business model, I mean more from a tax standpoint. Usually you will have a foreign entity or an Indian entity, or a foreign entity usually you will have, either it will be the parent company or the subsidiary company. What are the ways the transactions between the parent and the subsidiary are structured such that there is minimal amount of leakages from a withholding tax, GST, etc. So broadly, this is the topic for coverage today. And again, I have, I think, roughly about 1 hour, 10 minutes, I think. We'll try and cover as much as possible. And if there is any query, please pause me there. Happy to take question and sort of move. Okay, first and foremost, the idea here is if somebody has come to you as a client and asking you an advice, okay, I'm having an idea, I want to do startup. The first question that comes is, should I do it as a company or should I do it as an LLP? Simple thing, if it is a normal, smaller business, what would be the default choice? It will obviously be LLP because single layer tax, I pay tax at one level, take the money out as distribution of profit. No need to pay any extra taxes, dividend tax, etc. But the challenge, or not challenge rather, and also there is very low compliances that are applicable. There are no deposit rules. You can take loans from whoever you want and stuff like that. Having said this, in case of a startup, if you are going to form or into which you need to take a funding, if you are structured as an LLP, pretty much no one will give you money other than your friends and family. You will not be able to raise even an angel round in an LLP. So many of them, I've seen a few of the clients who have come to us, they would have started as a company, somebody would have told do LLP, they would have gone to LLP. To raise money again, they have to come back into company. So this back and forth flip keeps happening. So the point is simple. For startup, if you're doing it is not for tax saving, it is for value creation or value generation. If the idea is to raise money and grow the business, company is a form to be, while it has a lot of drawbacks or complexities. But the way the investors look at it is because of all this compliances and complexities, their rights should be protected. If it is LLP, pretty much the money is put as managing partner, you do whatever you want. Then the whole issue becomes a little bit of a murky matter to deal with between the investors. So broadly here, while LLP, everything is good, it is not a good structure form for a startup which will raise money from investors. That's a broad summary of it. Okay, now so far we talked about should it be a company or LLP. Next often debated aspect is, should I set up the company or the holding company overseas, or do I need to set it up in India and have a subsidiary overseas? Because most of the startups would be cross-border essentially. Being in Chennai, many of the SaaS companies are based out of Chennai. All of them will have a development center in India and the sales centers would be in the US. That's a standard example I'll take. Like say a Freshworks, a Zoho or anything like that. Now the question here will be, should I have a company that is a holding company outside of India, or do I need to have the holding company in India? This is the next bit. Once you've taken a call, always the setup will sort of follow. The question is, which is the better proposition to start? So till about couple of years before, setting up overseas used to be the default option, because many funds whom I have worked with, we work with, default structure is something like this. Say we invest only in US or Singapore companies. We like your business. You flip your structure into US, only then I'll make the funding. And that used to be the fairly standard practice, so to say. With the term sheet of investment, they also used to give the structure note saying that you need to flip, and that is a condition precedent for the funding to happen. And why the stress used to be to flip overseas is because of the investor rights being protected better. You can have flexibility of doing business, no angel tax, compliances are much easier, lighter, so to say. And also the thought process is, if it's US, for instance, the market is very large. I can go and do a listing. I'll get valued better. I'll also have an access to larger pool of investors. And this point is true because many funds do not have a mandate to invest into a emerging market company. Like only few have, or now a vast majority have, but it is nothing compared to being a US company for that matter. So the default choice is to be to go to a foreign jurisdiction because of these reasons. And amongst the foreign jurisdiction, next the choice comes whether I need to go to US or whether I need to go to Singapore, etc. That bit I'll come to it in a minute. But this used to be the story till about say 2 years before Zomato listing for that matter. After that, the thought process that many of the investors are having is, I am going to get, okay, Zomato started at 150, now it's at 60 rupees, whatever. But still you are at some 13, 14 times of your top line. The thought process that they're coming out with is, same company, if I list in US, I may be a $2 or a $5 billion company. Nobody will give me any importance because I'll be more like a penny stock in an ocean. Compared to that, if I'm in India, there are not too many startups available for people to invest in high growth companies. There is a good amount of demand, therefore the valuation would be better. This is the broad thought process that is going on. with which there is a renewed focus now to reevaluate which businesses need to come back into India. And that is the aspect which I was trying to tell in the introductory part. Like it is now going out is no longer the trend, coming back is becoming the trend. And again, now if you need to have a company set up outside of India, it needs to make an absolute sense. Only then you should sort of go ahead and do. With this, if I can get into little more specifics in terms of what sorts of business we are seeing of late. If it is largely B2C businesses, like having all the customers in India, everything happens in India, no point going abroad any longer. Like few of the clients we have got are in fintech space. All the lending is happening in India, tech is in India, lender is in India. Only thing what has happened, you got a holding company outside of India. Now the point is that overseas holding company is having no income. You cannot potentially list that company also. But at the same time, now what do we do with it? Because if I list in India, there is going to be a significant tax leakage. Just to give an example, say the structure is something like this. I've got investors in India and outside India. They are holding shares in a Singapore company, suppose. Singapore company in turn is holding shares in India company. If Singapore company is getting listed, it's very simple. Investors will sell the shares directly and get the money. So no complication there. Now the structure is something like Singapore company is holding shares in India company and India company is going for a listing. If I am a 5% shareholder in the Singapore company, I want an exit of my investment. The way it has to work is Singapore will first have to sell the India company shares after listing whenever. There's a 10% tax payment at that level. To take that money back from Singapore to my individual account as an investor, it has to be either a dividend or a buyback. So if I do dividend, it's a 35% tax. If it's individual, it's a company, you'll pay 25% tax, subject to ATM, of course. If I do buyback, I need to pay 22-23% tax. So what was a straight 10% tax effectively now becomes, because of India getting listed, money goes to Singapore and comes back into India. The leakage now jumps from 10 to roughly about 30 to 40%, depending on how you take out the money. Am I clear with the math and the concept broadly? Now, the same thing if I compare contrast with US. We are working with a client in US, which again has all the business in India. You just have a US holdco at the top. With US holdco at the top, if the IPO were to happen in India, the question there is, you cannot simply dismantle a US structure just like that, because there are US anti-inversion rules. With that, what is happening is, if India goes for a listing, US will have to sell shares of India company. There is a tax in US, capital gain tax of 20%. That's the first level of tax. To take the money out of US, most of the investors tend to be in Mauritius, Singapore, in respect of Indian startups. There's a 30% withholding on dividend. So effectively 20 plus 30, close to 50% tax is the leakage that is coming in. Now they're struggling, like there is no way out, unfortunately. So the point what I'm trying to make is, whenever we are now advising on structures, we should be a little more careful in terms of what is the end result. The idea is to just list overseas, and if that's not going to happen, it's a very difficult proposition to go abroad and take a listing proposition. So that said, many of the SaaS companies even today have a setup as a parent company in the US, because the thought process there is simple. I'm not going to go for listing either in India or US. I'll build a product. One of the larger tech players is going to acquire me. And for the acquisition, if you're building the structure up for acquisition, then the thought process is whichever the acquirer prefers, you set up the structure that way. Then if it's a SaaS entity, all the business will be within India and US for that matter. Local business you have in US. You can still have a US headquarters essentially. And ultimately, once the business is mature after 5-10 years, whatever, you simply sell it off to a Microsoft equivalent and walk away. So that structure works. So the sum and substance of it is, going abroad is no longer the default option. If you need to go abroad, it should be backed by business. If you are having a lot of business outside, and if you're building the business for a sale outside, go for a US holdco. If it is largely B2C businesses, which everything happens to be in India, being in India itself may be a better option going forward. So this is the summary of it. Any perspective on this, or can I proceed? Is it too fast? Yeah. Now, going into jurisdictions, Okay, assuming for now, if it is India structure, then nothing to structure about. It's already in an India company. Assuming we want to go to US or a Singapore for that matter, we'll focus on some 3-4 options in terms of how do I flip the structure. I'll also speak about it in terms of if I want to come back into India, what are the options to do alongside these options. Now, in terms of jurisdictions, Singapore used to be the preferred jurisdiction for most of the B2C companies. Like you have read recently, it's in public domain. PhonePe was in Singapore, they've dismantled Singapore and then they've moved back to India for doing the listing. And that's come at $1 billion cost. It's all in public domain, whatever I'm saying. Flipkart historically has been in Singapore. But if they have to go for a listing, then they also have to figure out if I need to do an India listing, whether that structure is good enough or no. So the default options used to be that I go for Singapore if it's India-centric business or if I am having a lot of Southeast Asian business. However, if it is going to be SaaS and US market-related business, like if I'm having a lot of customers within the US, then one can consider US as a headquarters. Otherwise, if you're not having US business per se, US is a very expensive and a complicated jurisdiction to be in. And while I put other jurisdictions, you'll not find more than like say 10% of the companies going into other jurisdictions like say UK or an Ireland. While Ireland is generally good, that is more for US companies to have their setups in Ireland. It's not other way around that I have an Irish holding company which will have business setup across. So that's broadly there. And again, Mauritius and UAE, while I put, those are all the fund jurisdictions to invest into India and not necessarily to set up the holding company. Okay. Now I'll move to the structure setup part of it. So as I mentioned earlier, till August 22, 99% of the structures have been set up under the gift route. What I mean by gift route is, you'll find a friend or a family member, relative, whoever, being in US or Singapore. Most of them will be in the US, obviously. The structure would be something like this, that person will put some $5,000, set up a company in the US, Singapore, wherever. That Singapore company will put a lakh of capital into India, set up the India company. So then it is like non-resident relative holding shares in a US entity in turn holding shares in India company. This used to be the standard setup that used to take place. After the setup is done, you simply take the shares of the US company and gift it to whoever are the founders in India. With that, the structure used to be like you have the India founders having shares in, say, a Singapore company, which in turn holds an India company. Point used to be, or the legal position used to be that receipt of gift is permissible under automatic route. And again, RBI was perfectly fine with it, though they were uncomfortable with it. And I have not violated any law because I have not wired any money from India. The round tripping, etc. applies when I have remitted money. If I have not remitted money, round tripping was not applicable. This used to be the default position, which hundreds, if not thousands of companies have got set up in the exact same manner. Then RBI brought up this rule in 2022 August, saying that gift you can now get only from your blood relative, defined, and any other gift they have pushed it within the purview of FCRA, Foreign Contribution Regulation Act, which will not get an approval to start with. And also the thought process is whichever structures you are holding shares in a foreign entity without doing a reporting under ODI, we need to go and regularize that. So this is the current position where gift is, technically speaking, no longer viable or permissible. If that is not there, then the next question comes as an individual, can I make an investment into US company as an individual under LRS, for instance, and hold 100% stake? That will be the next question. So that again is not permissible, because if I hold as an individual control in a foreign entity, that foreign entity cannot have subsidiary anywhere in the world. So that individual holding route also has been blocked, or rather never it was permitted, they have kept it that way. Now the only route that is permissible is the resident individuals can set up an entity in India, which can be either an LLP company or a partnership firm, put capital into that entity. That entity can set up a foreign company. That foreign company can back-to-back set up a India company as a development center, etc. This is permitted. Put it differently, round tripping has been specifically recognized for the first time, and then they have permitted it, as long as there are not more than 2 layers. I'll come to it a little later. But the current situation is I will have residents hold an Indian entity which will go ahead and do the ODI investment, which can also have a round trip leg to it. Then the next question that typically comes is, should I do the holding vehicle in India as a partnership firm, LLP, or a company? So if I do it as a company, it ends up becoming like an NBFC, which you can always break it by having some amount of operating income in that entity. Same, but the problem with doing a company is eventually whenever you sell, money comes to company. If you have to take it out, you need to pay a second layer of tax, which is obvious dividend or buyback tax one needs to pay. Then you are left with an option between LLP and a firm. But LLP again, not many of people may be aware because it's not there anywhere in the law. You're not allowed to undertake financial services activity within an LLP. Because the way it goes is, by the time you're setting up the LLP, if you're clicking that or if you're choosing your activity to be financial services, it will ask you to sort of, through resubmission otherwise, enclose an RBI approval. And RBI will not give an approval because RBI Act does not cover LLPs within its ambit. So essentially, then the structure will be that you set up the LLP as, say, a consulting LLP for that matter. You go ahead and then do all the filings. End of the year, if you're not having any income, only investment that you're holding, you'll get a notice from ROC, saying that why don't you convert yourself into a company and then go for a registration as an NBFC. So LLP also as a route is not viable. Then you're left with a partnership firm, and that is what we have been generally doing, a general partnership firm, which is registered with the registrar of firms, and that is entirely eligible to go ahead and do this ODI. And again, from a capital standpoint, any money I put into the firm, I can do investment up to 4 times the net worth. So that way, there is no paucity of capital in this structure. I'll just pause here. This is about the structure setup, assuming I'm going abroad. Clear so far? Which one? So CIC is okay as long as I'm making the investment into group companies, I can fall within CIC. Registration also may not be necessary if I'm not accessing public funds. Problem with the company structure is, even I can simply break the NBFC threshold by having some operating income. That's not a big deal. But whenever this exit happens, money comes into the company and I need to take it out. To take it out, I will pay, whether it's CIC, NBFC, or a normal company, I need to pay either a dividend tax or a buyback tax to pull the money out, which is not applicable in case of a firm or an LLP. And again, given the income will be capital gain, there is no rate arbitrage because it's 20% itself, whether it's a company or a firm. If it had been business income, then the rate would be 22 versus 30. That arbitrage is there. Here, that leakage also is not. Firm is suitable. And startups, nobody sets it up for life because either it has to be sold, it will wind down, very few go for IPO. Okay. So this was a condition I was talking about round tripping. Historically, there was no definition of round tripping. We used to generally understand in terms of round tripping from compounding orders of RBI. Round tripping structure was something like this, where you have an Indian shareholder putting money into a foreign entity, that foreign entity having some sort of an investment back into India. Round trip is essentially some investment pool started from India, went to an overseas entity, and then it comes back into India, which we call as a classical round tripping, which RBI was never comfortable with. But with a lot of demand from the startup sector, etc., now they have permitted it. All that now they're trying to say is, as long as there are not more than 2 layers in between, if I make an investment into a foreign company, that foreign company to the India company, there should not be more than 2 layers. As long as that condition is sort of taken care, I put a pictorial diagram, I'll say what is permissible, not permissible. Then we are sort of fine with it. Here, if you look at it, structure is something like this. You got ABC LLC USA, which holds Singapore. Singapore in turn holds India. Now this private limited company, which is on the left, is proposing to make an ODI into this US entity. Question is there round tripping? Yes or no? No round tripping. Not asking whether it's permissible or not. I'm asking, is it a round trip structure? It's a round trip structure. Clear, no? Because India guy is investing in USA, USA to Singapore, back to India. This is a round trip structure. Now, if you look at it, the investment has gone into US. US to India, there are not more than 2 layers. There's only 1 layer in Singapore. Therefore, this seems to be fine. Similar thing. Here, if you look at it, India company is planning to put into US. US has Singapore. Singapore in turn has Luxembourg. Luxembourg has investment back into India. Is this okay? Not okay, because there are essentially 3 foreign layers. Because I put money into US, then US, Singapore, Luxembourg. There's a little bit of ambiguity between the banks whether I should count the US entity or the layers only below the US entity. At least our view seems to be this should not be permissible. Earlier one is fairly clean. Okay with this bit? So just going back to this. This is the structure essentially. Then I'll have the India firm putting money into Singapore or US for that matter. And in a startup construct, that Singapore or US will directly hold the India subsidiary. Now the question would come like, why do I need to have in the structure an India subsidiary? Okay. Any reason why I need to have India subsidiary? Can I just not have any structure set up at all in India? And the question is, I need to have my operations in India. If I need to have the operations, I cannot put the operations in the firm, because I will end up raising money from the investors at the foreign company level. If I'm raising money at the foreign company level, the entire operation should be at the foreign company or below the foreign company. If I have all the operations at the foreign company level, then India I cannot have any staff without triggering a branch. And to trigger a branch, it's quite complicated from a tax perspective. That's why I need to have an entity in India. If I have an entity, it becomes round tripping, and that is the reason why we are doing it in this particular manner. Okay. Next part is, okay, now so far we have seen entity firm, how to go abroad, and assuming that's a decision that the client has taken or we are taking for the client, that the business should be set up overseas. 2 ways to look at it. If it's a new business, then nothing to worry. Simply I'll set up everything and hire all the people all over. Not all over, like for the first time I'll hire in the proper structure. Many cases what happens is, whichever founders we speak, they will not be okay to do the structure first. Their thought process would be, I have limited money, let me do the business with the money instead of trying to put up a structure and lose a lot of money. So more often than not, what happens is they would have started the business in India with a reasonable amount of capital. Business also would have grown up to a particular level, and that point in time, I need to do the flipping of the structure. And that's where the complexity comes in. If I'm needing to set up newly, then there's no problem. I'll just take $5,000 or $10,000, just set up the company and set up the company in India. I'm done with it. But the complexity will come where I've already set up the business and I want to flip it into this offshore structure. So that's what we call as flipping. So here, if you look at it, broadly I put 3 options. Just talking through this, what do I mean by flip is, there is the business of the existing India company. Somehow I need to push it into the new India company. Here, if you look at it, existing India company had investors directly. I want to interpose a Singapore holding company here between the investors and the India company, or Indian operations for that matter. With that, what essentially happens is, going forward, Singapore would be my headquarters. I will raise all the capital in the Singapore company and my business would sort of flow from there. This is the thought process of flipping essentially. 2 ways to do it. One is, I sort of leave the old structure as is, migrate everything into the new structure. Or the first option was where I sort of use the existing structure itself. This is the simplest way of doing it. All that we need to do is, we will set up the new structure the way we discussed. through a firm, whatever that could be, which will have the Singapore company set up. Singapore will set up a new India company. Clear? Now, the boxes or the shells have been set up. Now, I need to populate it with people and operations. Now, people and operations, where are they? They are in the existing India company. I need to transition them into the new India company. Now, what are the ways to move the business? I'll either do it as a slump sale or I'll do it as an asset sale. Or we are doing a hybrid where I'm not doing any sale at all, just move the people and lease the asset. Clear? After doing all this, what essentially happens is, India company, the old India company becomes a shell company. All the operations effectively would move to the new India company. And thereafter, that moving the business would include moving of contracts, people, assets, clients, everything. And after this stage, essentially what happens is the India company, the new India company will be the functional company for the group going forward. If I do this transition, the flip is sort of completed or concluded. Clear with the broad concept at least? Now comes the thing of what are the risks associated with it. So any guesses? So now structure risk is not there because round trip is permissible. Now it's only the transition related risk. Generally speaking, slump sale where I can do it at book value, etc. Simple thing is, if say my asset has a net worth of 100, will the fair value of the business be 100 or more than 100? My book value is 100 of all the assets and liabilities, asset minus liability is 100 suppose. If I have to sell the business, will I get more than 100 or less than 100? More than 100, and if it's a going concern, I will get much more than 100. And in case of startup, usually your fair value to book value, the ratio would be like said 8 to 10 times. Now comes the question, like say this business, India business is valued at 100 million from a funding standpoint. It may have an asset base of only 10 million. Now the company is worth 100 million. Assets are in the books being carried at 10 million. That will be most likely scenario in most of the cases. Now the question is, if I do the slump sale here of a company whose business is valued at 100 million, at a 10 million, will GAR apply? Because if the company is worth 100 million, then business also should be worth 100 million. It cannot be anything less than 100 million, conceptually. Now, and again, I'm selling the entire business at one go. Is there any risk that one would foresee here? Or is it easily digestible and doable? Any view? At a markup. Yeah. No, fair argument. And other thing is, we never made any cash in this particular thing because whatever has happened, I have just interposed one entity. But if you look at it from a FEMA standpoint, from a consolidated view standpoint, if I was supposed to sell the India company to the Singapore company, the sale should have happened at 100 million because there are resident shareholders. This will become a sale of a company from a resident to a non-resident. Correct? Then minimum FMV I should have collected for making the sale of the shares. Just because I'm selling the business within India, technically speaking, FEMA is not applicable. Does transfer pricing apply to such a transaction? Yes or no? Because both parties are in India, no? Why transfer pricing will apply? Buyer and seller both are in India. For TP, one of the party at least has to be non-resident, or non-resident should have had a play in the valuation. Here we'll keep the non-resident out of it. So it is one India company seller, one India company buyer. TP technically does not apply. That said, now from a FEMA and a GAR standpoint, if you look at it, it is little hard to digest for anybody to say that the $100 million business, I have simply sold it at 10 million today and walked away from it. Clear? And again, that 10 million also is not there in terms of cash in the new company to pay. So about 6-7 years, this used to be the way to do that. I set up and do the slump sale. The variations or the improvements in the structure is what we have been doing off late is at least don't do a slump sale because it's a full business that is getting sold. You transition the business over a period of time. What we call as ramp up and ramp down. What do I mean by ramp up is whoever is sort of all the new hires I want to have because the business is going to grow, all the new hire I'll take them directly in the India company. So with that, what happens is that old company sort of stagnates and over a period of time sort of tapers down, because anybody quitting there, I'll not hire them in the old company, I'll hire them in the new company. Now, if I have a span of like about 2 years, 1.5 years, then it's a very good structure to do something like this, which is a gradual ramp up and ramp down. Many cases, it won't be the situation where I'll need to do it fairly quickly. If I need to do it fairly quickly, the way to do it is if I bunch up everything and do it as a slump sale, perceptibly the risk is higher compared to leave all the assets behind and only move the people. If I'm moving the people, then no one can allege saying that I've sold the business, etc. So if I move the people, then what is the role or function of that old entity? All that it has is now laptops and computers. I'll do a lease of that laptop and computers to the new entity. So everything will go as normal. Except for that, instead of having a sale consideration for the sale of the asset, I'll have to pay lease premium for, or lease consideration, lease rental rather, for the lease of the asset. This way, what I'm trying to do is, what would have been a slump sale, we are sort of breaking it into movement of people followed by a lease. Even if you don't want that asset, you don't do that lease also, just move the people and you can sort of ramp up the operations in the new structure. Fairly clear with, while I have not put too much on the slide, I am talking through the various facets of it, including the risks that are there. Now, this is a way where we do it as a taxable transaction per se, because there is no exemption that is available here. But while I am doing it as a taxable transaction, the play is on the valuation. Because valuation, I'll keep it closer to the book values or anything like that, so that there is no significant value shift that is expectedly happening. Clear with this? So cash also, I sort of loan it out. Yeah. If I'm doing a slump sale, cash will go along with the slump sale. That will be a payable receivable. The way the transaction documents would read is, this money consideration would be paid within 120 days or 90 days, or as may be mutually agreed between the parties. I'm coming to that. I'll take that point. Yeah. I'll take that point. Yes. Sorry, slump sale 56.210 applies to specified assets. Business is not a specified asset for the purpose of 56.210. If it's immobile property, cash, all of it, bullion, jewelry, etc. gets covered. Business is not an asset within the meaning of 56.210 asset. 56.210 takes you back to 56.27. It's not a specified asset. Yeah. No, in generally in startup, no one has immobile property. They'll hardly pay rent or struggle to pay rent. So there will be no immobile property. Rarely you will find immobile property. If it is there also, don't sell the asset, just lease it out. Then there are few other points here. Okay, if I've just moved the business and not sort of moved the IP, etc., what do I do with the IP? That is a question I'll come to this investor bit last as AIF. Next comes the question of IP. In a structure like this, where do I want to keep the IP? In New India company, Old India company, or Singapore company? Singapore company. Now IP so far was sitting in Old India company. Now if I want to move the IP from Old India company to the Singapore company, is it a transaction falling within the purview of transfer pricing? It applies, because both will be related or common ownership. Related, and one is non-resident, other entity is resident, TP will apply. Now I have seen few cases, few of the valuers doing the valuation of the IP. I'll just give a live example what we saw. Business was a loss-making business. Company was valued at 400 million. The whole play was that we have built IP, and because of that future potential of the IP, somebody was giving them that valuation. This company has gone and done the IP valuation at $2 million and then sold it to Singapore in a structure like this. Now comes the question, if the company value was 400 million, loss making, can the IP be valued 2 million? basically is logical, not logical. Illogical if you ask me, because for a loss-making business, your operating income is negative. All the value, whatever is there is for the IP and everything else associated with the IP that you have generated, etc. So it is almost impossible to do. And we also went in one other case to a large US valuation firm. Rule of thumb, what they were saying is for a B2C business, IP value is usually just the trademark or the brand value is around 30% of your total value of the company. So in this case, just the name would have been worth like say 30-40% of the total value. So they did, then they got stuck, something happened. But the way to sort of deal with the IP would be, one way to look at it is, in any startup what happens is, any IP that is there today will not be the same in terms of value 3 or 4 years hence. Agree, because you need to sort of incrementally update it essentially. So there is this US, they have adopted this concept of die on the vine approach. What do I mean by die on the vine approaches? IP I've generated today up to this level, which is say the base IP. And the incremental creation on top of base IP, I will put it in terms of ownership with the Singapore company. So which means base IP is here today. All the layering on top of it belongs to Singapore company. After a 3 or a 4 year period, this base IP will become effectively useless, because its value that is there today, if it was 100, over a period of 5 years, it may become 0. Value of the new IP, what is 0 today, over a period of 5 or 8 years will become 100, because it is like old IP will slide, new IP will actually start from 0 and go up. With that methodology at play, effectively then what will happen is, I don't need to do the IP movement today. I can do a license of the IP at some royalty, etc. Keep the exclusive license within the structure, maybe into the old India company itself, and then do all the new IP development in the Singapore company. That way the IP transition also sort of gets taken care. Clear with the IP movement, asset movement, people movement. Next comes the investors movement. Now here if you look at it, if say I am an investor who has put like say 5 million in the India company, just because we are flipping, will I be okay to put 5 million all over again to get the same stake? Will you reinvest the same money for getting the exact same stake, or would you want the stake coming to you at a nominal cost? Nominal cost, because you already put the money that has been utilized by the company, suppose. If I am a 10% shareholder and the value of the company is say 50 million, I don't need to put another 5 million to get the same 10% in the new company. Conceptually clear? Then now the question would come, okay, if I put the money, I'll have to put nominal money essentially. I may put like $1,000, whatever. Against that $1,000, I'll end up getting the 10% stake. In my hands as a shareholder, if you look at it, I am holding 10% in the old company with a cost of 5 million. I'm holding 10% in the new company with a cost of $1,000. Then the question is, what happens to this cost base? How will I be able to sort of switch this cost base into the new entity? That will be the typical question that will come. So there's no way to amalgamate the cost in a structure like this. So what is the advice generally is, till you sell the new company, you continue to hold shares in the old company. Whenever you are selling the new company to an investor, you please sell the shares in the old company to an unrelated party, so that I book a gain and I book a loss. Effectively, my cost is getting averaged out. Clear? This is a way to sort of take the benefit of cost and also not booking the loss at the same time at the initial stage itself. So that indexation, whatever is it, that will continue. Next question is, AIFs cannot put money into an offshore company without getting a specific SEBI approval. For any AIF that is an alternate investment fund, putting money in a foreign company, you will need to take care of 2 requirements. One is I need a specific SEBI approval, and there are 2 conditions, like of the AIF's corpus, more than 25% cannot be put in a foreign company, not single company is there. This is all foreign companies put together cannot be more than 25%. And also there is an annual limit of $1.5 billion for all AIFs put together in India. That usually gets over in about 5-6 months, and then you will not be able to do. So those sort of cases, what we have been generally doing is, they will put some nominal money into the India company, it's a new India company, and put in an option agreement. So the structure of that option agreement is, while they are holding shares in the India company, the value of that stake will be equal to 10% stake in the foreign company. And this is a standard structure that has been sort of accepted of late. So I'll just reiterate. I've got a alternate investment fund. Forget this flipping on all. Generally, I also am saying. The structure is something like this, which is Singapore and India companies below Singapore. They want to make the investment into Singapore company. If I need to go to make the investment into Singapore company, I need SEBI approval, and say SEBI approval is not coming for whatever reason. To overcome this situation, the structure that is at play generally is, you get the AIF to put money into the new India company. You allocate them some stake like OCD, OCRPS, CCPS, whatever that could be. The value of it is linked to the Singapore cap table. Had it been in Singapore, whatever would have been the value, that will be the value of that company. So this is what we call a synthetic stake or derivative stake or put call structure. These are the names that are given. Because I am holding on to some asset, that asset is not equal to whatever I am holding, it is actually linked to something else in Singapore. And from a investor rights protection standpoint, what happens is it is going to be a single shareholders agreement involving Singapore and the India company. So that way there is no loss of any rights for anybody. It's clear? Okay, this was most of the cases indirect transfer will come. Correct. If it is below, yeah. You're even better off, no? That you use loss elsewhere, no? If you're not required to pay tax on income, why you want to set off? No, you use it somewhere else, no? It's better, no? What would have been taxable, you got it tax-free, plus you got a loss on your hands. So it is better. Okay, this slump sale, asset sale, and this is a little brute force of doing it, where I'm doing a new entity and then do all of it. This structure also we have done in many cases, where say there is already a 75-80% non-resident shareholding in the company, in the India company. I'll repeat. Already foreign shareholders or non-resident shareholders are holding 70-80% in the India company. Most of them may be treaty protected, non-treaty protected, whatever that could be. The way the structure will work is a new Singapore company will be set up, obviously. And then all the shareholders in the India company, barring the resident guys, will swap their shares into the Singapore company. So effectively, what would have been direct holding of non-resident shareholders will get routed via the Singapore company. With this, then what happens is I'm not required to do any transition of people, business, etc. I've just done a shareholding switch. With that shareholding switch, what is happening is I'm putting Singapore company on top. So this works generally where there is no run-up, significant run-up in terms of value from the time of investment to the flip. Now comes the question of how do I get the founders to pick up the stake without tax? Because those guys would have the lowest cost base. Generally speaking, the structure that is usually adopted is founders would put money into the Singapore company at the time of setup. You just put some $5,000, whatever that could be. That will form part of your stake going forward in the Singapore company, and your existing stake in India company held by the founders would be cancelled or bought back. Just repeat. I am a founder holding 20% shares in the India company. Now I need to get 20% shares in the Singapore company. That's the bottom line. Simple thing would have been what? I'll take the 20% shares and swap it into Singapore. Assuming under FEMA it is possible, etc. Unfortunately, in India, swap of shares, though I'm not getting cash in return, is liable to tax. Many cases, what happens is they may not have money to pay tax. See, that's the general situation that you will encounter. To overcome this situation, what is the usual traditional way of doing is, I'll give them stake at the time of formation of the company. Then there is no tax issue because you have yourself set up the company. Clear at that step? Then the non-residents, etc. would swap in. Effectively, if you look at it from a founder standpoint, you are holding two stakes. 20% in the India company, plus you are holding 20% in the Singapore company. Correct? Because whatever you are holding, you are continuing to hold, plus you got 20% in the Singapore company. To make the economics align, all that we need to do is get the shares of the founders in the India company cancelled. Typically, we do it as a buyback because it's exempt, and whatever value you do, you cancel out the shares and you're done with it. With this buyback, effectively, you simply switch the founder's stake, what was an India company, to the Singapore company. Okay. Maybe a little complicated, but I just wanted to give the flavor of what really happens in case of a flip. Under ODI rules, swap, you need approval because it requires allotment of shares by the Indian entity. So that's the thing. So that's why point I'm trying to make is you cannot swap. If you would have swapped, you would have paid tax. Here I'm not swapping, no tax either. Cancel it off. Okay. This merger demerger is something similar to slump sale, asset sale. Conceptually it's same, like I set up a new company and then merge it into that. I'll not spend too much time, it will flow in the same way. Only thing here, there's a little bit of play around the valuation. So I'll just leave it now, it's taped also. Okay. With this, now we have spoken about how do I set up the structure or how do I move the structure. Here on, it's not going to be around the M&A, it's more a little bit on the transfer pricing and the structuring part of it. So generally speaking, say I'm just taking Singapore example everywhere, it can be US or whatever. Most of the cases or all the cases, the standard form is that there will be very minimal employees in Singapore or the holding company for that matter. All the entire tech team will be based in India, where you will be sort of doing the development work. Now the requirement is for me to hold the IP in the holding company. The simple thing that we have been doing traditionally is just put a cost plus arrangement whereby India company will do the development of the IP for the Singapore company. Clear? With that, the IP ownership effectively is held in Singapore. The question is with this base erosion, BEPS regime, etc., there has to be some substance in Singapore. So the thing is, there has to be people who are at a senior level who are directing the development of the IP, etc. So all those things are required for Singapore to be the exclusive economic owner of the IP. That is given. I am not contesting on any of those things. Now comes the question of, okay, India company is getting money on a cost plus basis. Okay. For this particular IP, there are customers in India, there are customers outside of India also. Now I'm talking about how do I deal with the customers within India. Okay. Now function of India company, if you look at it, is twofold. One is it is doing the development of the IP, which comes under cost plus. That we are all clear, cost plus 16-18%, whatever you want, you put. Then the other function of the India company is it is essentially also doing the monetization of the IP. Say it is a simple software product if I take, I just need to find a customer. I need to install this particular product at the customer's systems, do the testing and do the rollout. That's a general process that will be there, which is apart from your IP development, it is going to be around marketing, then deployment of the solution. After you deploy the solution, testing and monetization. Clear? Now the question is, many cases what happens in startups is as a group there will be loss making. Now I cannot have an entity in India which is only cost plus, where I simply keep accumulating profit on a cost plus basis. Then it will be unviable for the business because there's a huge leakage insofar as the structure is concerned. Because Singapore I'll have loss, India I'll have profit, I cannot offset the two against each other. Now, the monetization part in India can be done two ways. India can act as the agent of the Singapore entity. You undertake all the marketing support, etc. You get paid on cost plus basis for that also. Just that the margin instead of being 16%, maybe 10-12%. Clear? If you were to do this, what ends up happening? India is completely cost plus. IP development is cost plus 16. Then your all other sales support, etc. would be at cost plus 10. Singapore is having more and more losses. Clear? That's what essentially happens. So given this challenge, what we have been implementing is the India company's function can be, part of the function can be essentially development of IP. Other part can be in terms of the market entrepreneurial setup essentially. What do I mean by that entrepreneurial setup is, it takes upon itself to do the monetization of the IP. It will go find customer, do the deployment of the IP, etc. After incurring all the costs from the revenue, recouping whatever is remaining, if any money is remaining, only then it will pay royalty to Singapore. Clear? Then effectively what happens is, one was cost plus and other is a entrepreneurial entity. I will end up most likely incurring a loss under the entrepreneurial entity side, which I can use to offset my cost plus structure. Clear? Now, many cases like what we also seen is stop loss. Like generally in these sort of cases, it will be that I will pay royalty of 10% of the sales will be, usually. If I need to simply pay royalty, there's a TDS of 10% here that will come in, which is not recoupable because in Singapore I'll be making loss. So generally the stop loss arrangement is quite prevalent in US, Singapore and all. What it says is, till the time the India subsidiary is profitable, I will not take any royalty. Meaning to say, if there is a loss, the logic is that if there is a loss, parent anyway has to fund India company extra. So if taking royalty and putting the money back as equity, I will not take royalty till the time India is profitable. By doing this stop loss for a period of 4 years, 5 years, whatever you sort of agree, no royalty would be payable. Effectively, we are reducing intercompany transactions between the companies and reducing the leakage to a minimum. So this is a broad structure, what has been implemented, and this has gone past TP also multiple times. Okay. This was what I was saying. Okay. Then this we have been working with a lot of SaaS companies around same structure. So the structure is something like this, or problem statement rather. There's an India company which has developed the product. Now I've got a US entity which will simply do the sale or marketing of the product. Many cases what happens in startup scenarios, US may have a revenue of say 10 million. Its cost of selling that product may be 15 million. So 10 million is a total revenue and cost of deploying, selling the product may be 15 million. In this sort of a scenario, the base case model would have been US is doing a license or sub-license of the product. Entire 10 million minus some markup had to come back to India, correct? So it's an India company's product which US has onward gone and sold to customer. 10 million was a sale, 10 million minus some markup will come to India, and India has to pay back 15 million to US to do the marketing support. That's the usual way it sort of works. Here if you look at it, what happens is US will have to pay huge royalty to India. There's a TDS leakage there, and in the US withholding tax. India has to then make a $15 million payment back to US. There, whether withholding tax applies or not, it's a little debatable and make available all of it. And then again, any payment made by India, there could be a reverse charge implication under GST. And also you will have this exchange loss of multiple transactions coming in and out. Each time you sort of remit, there is going to be a leakage. So in these sort of cases, what model we have been implementing is something like this, where US and India enter into that similar limited risk distributor model, LRD, what is being called. The understanding here will be that US will do the deployment of the solution. It will recoup all of its cost plus a markup. Only if any money is remaining, that will come back to India as royalty. So instead of doing a gross settlement of 10 coming to India and 15 going out of India, I'm doing a net settlement. In this particular case, only net balance, whatever is there, alone needs to be paid from India to US or US to India. Am I clear? Making sense? Okay. So this is essentially, like in many cases, is seen to be quite a bit of saving. Yeah. No, what I'm trying to say here is, okay, now whether withholding tax, what is royalty versus product, there's a little bit of a confusion, whether it's the digital goods, etc. Many cases, what we have been given to understand is if there is some customization, it takes a color of royalty. Okay. Then the question now is, I could have, if it's just a LRD model, then they'll keep some 3% margin, whatever, push the entire money back to India. Then India has to pay for the marketing support. That's the way it will be, like full money I collect and I have to pay it back. That's the model that everybody has been doing. There, let me take an example of 10 million being the sales to customer and 9 million being the USS entitlement. What would have happened? 10 million will come to India and India has to pay 9 million. All that I am trying to say is 10 minus 9 they'll keep there only. Only 1 million they'll pay back to India. Instead of doing a gross settlement, we are doing a net settlement. Under FEMA, again, it is not that I'm netting off invoices. It's essentially happening within the contract itself before the invoice is raised. Last, how many minutes have? Okay, perfect. So next bit is on management ESOP or incentive plan. So the context will be something like this. Many cases, startup founders would be like holding stakes less than 20% generally. Because what happens is each round of investment, there is a 20 to 30% dilution that takes place. After the three rounds of dilution, the founders would be like sub 20%. That's the general trend that you will find in any startup. Then the question that will come is there enough skin in the game for the founders to continue running the business? Or are they sort of, if the shares are vested, why should they continue here? Can they sort of start a new business? That would be the usual logic that will come. Also, other thing would be that, okay, founders have done so much for the investors, they also want something in return. That will be the other way to sort of look at it. So many cases, it's a combination of these factors where founders have got unusually diluted down so that they need to be incentivized being in the company and running the business going forward. Also, it could be that they have agreed for some performance metrics. We have worked with a client where the logic was something like this. For every $1 billion increase in valuation of the company, the founder should get 1% extra stake in the company. So this is the commercial requirement that they have sort of agreed upon. Now the whole point is, how do you sort of structure this in an efficient manner, I would say, within the purview of the law. Effectively, that's the overarching requirement. Because many companies will go into listing, there will be a scrutiny of the structure, so it should stand the test of scrutiny. So these are the things, like there are about 7-8 variants. I've covered 4 or 5 of them, and I'll talk through the others also. So the end objective is, founders today were at 20%. After this structure, they should become 25%. What is the simplest way to increase stake of somebody? Allot shares or allot ESOPs, correct? One of the two things it has to be, because ESOP also will become shares. If I don't want to do ESOP, I can do shares. ESOP, what happens from a tax standpoint? When I grant ESOP, there is no tax at that point in time. Whenever the exercise happens, it will become salary income on the entire value of the ESOP at that time. Withholding has to be done by the company, and then the founder has to sort of figure a way to put the liquidity on table. Clear? And also, more importantly, what happens in many startups, not in many, in all startups, any ESOP expense you take, that hits your P&L and it impacts your EBITDA. So that's why a few of the startups of late, if you look at it, Zomato was sort of showing EBITDA before ESOP expense and EBITDA after ESOP expense, because there was some 300 crore of ESOP hit. Now, many cases, the whole point is tax is as much a consideration compared to even sort of safeguarding your P&L. If this is a requirement, what are the ways to sort of do it, which is both efficient from a tax as well as a accounting standpoint? So that would be the objective of this discussion. Simply put, I could have done an ESOP and concluded with that structure. Now, ESOP, again, for founders, I can do if I'm a startup. But the startup definition has undergone a change that if I'm today a holding company or a subsidiary company, I'll lose my startup status. So effectively, like say, many cases, if I've got an India company, I'll have presence overseas. If I set up a subsidiary, that moment onwards, I lose my status as a startup. So it's a little unfortunate, but that's the way they brought it in. Now I'll just talk through the options that are there, what are generally being implemented. So one way to sort of take care of it, this stake increase from 20 to 25% would be to allot partly paid up shares. Warrants also work in a similar manner. With partly paid up share, what happens is, founder has to put only 1 rupee today. He will pick up shares partly paid today, which he can sort of make it fully paid up over a period of 5 years or 10 years, as the case may be. Clear? Now, partly paid up share, if I am allotting, period of holding, etc. starts from today. Any extra money I pay, that becomes cost of improvement effectively. So from a classification standpoint, it takes a color of long-term capital gain because the asset is long-term. Clear? Next comes the question, okay, why am I allotting the shares today and why cannot I allot it after 5 years once and for all? By allotting the partly paid shares today, what I'm effectively doing is I'm locking in the price, because if today the price is 100 rupees, I lock in the price at 100. Tomorrow, if the price becomes 150 or 200, I'm not required to put 150 or 200. So the objective of doing a partly paid share is to lock up the price without having to pay the full consideration. That's the overarching requirement. Same thing I can accomplish even through a share warrant. There's some debate in the market, can unlisted company do share warrant, etc. Because under that warrant, it says that as per SEBI rules, that while that confusion is there, the practice seems to be okay. When in case of warrant, if it's a resident allotment, I can collect 1 rupee and allot warrant. Only difference between partly paid share and warrant is whenever I exercise the warrant, the period of holding starts from that date or not from the date of allotment of warrant. So there's a trade-off between the two that is there. And again, warrant I cannot give voting right, and partly paid share for whatever it's worth I can give voting right. That is the other facet that is there. Now we have discussed about partly paid share and why somebody needs to do partly paid share, or what's the advantage of it is locking the price and locking the period of holding. Next comes the question, if the company's revenue value is say 100 rupees, if I allot the shares at 60 rupees, is there any tax incidence for the founder? 100 rupees is revenue value, equity share. I've allotted the shares at 60. Any tax for the founder? Yes, no, it's simple. 56(2)(10) will apply. On this 40 rupees, tax needs to be paid. Same example, 100 rupees revenue value. Fair value under DCF is say 250. I'm doing the allotment at 100. Any problem? Revenue 100, allotment price 100, DCF value 250. Any issue? No problem. Under 56(2)(10), as long as you allotted at or above revenue, we are good with it. Only concern here that comes is, if I am giving the shares to the founder, it can take the color of ESOP. Once it takes the color of ESOP, your revenue will not apply, your perquisite valuation will apply, which is the merchant banker valuation, which will be the full fair value will be the taxable value. Full fair value is 250 in this example, minus 100, the founder will need to pay tax. Clear with the broad framework? Given this, we have seen cases, implemented cases where the allotment is being done at 250, which is the DCF value. We've also seen enough number of cases where the allotment is done at 100 or 110 rupees for that matter, which is above the revenue value. Only thing is, if it is done at 100 or around 100, the overarching requirement is that it is not linked to the terms of employment. If you link it to terms of employment, it becomes like an ESOP. Here it is going to be an independent allotment that is being done. So that's in terms of allotment price. Next question that comes is, who will pay for the consideration? The founder has to pay the consideration. Where is the cash that is going to come? Many cases, the way it is negotiated is the company only will pay the cash and collect it back as allotment price. So company will give you a one-time bonus, which you sort of put it back into the company towards making the shares fully paid up. But this bonus I'm not going to do today. I'll do this bonus end of 5th or 6th year, whenever that could be, such that the tax incidence from today is getting deferred to a later date, while the pricing, everything got frozen today. Understood the broad concept, where future upside from today's value, whatever is there, everything takes the color of capital gain. Today's value, be it revenue or perquisite, that anyway becomes, if it is going to be a cashless, it takes the color of salary, no problem. By doing the bonus after 3 or 5 years, I'm deferring that tax also to a later date. Clear? It's all within the purview of law itself, so there's nothing gray about it. And then there's one more concept saying, if the company has P&L profit in P&L, as per section 123, I can use that to pay up the partly paid share and make it fully paid share. Just give an example. Say 11-year value of the share was 100. I allotted the share partly paid at 1 rupee, 99 rupees remaining unpaid, assuming everything is face value for now. I can use the balance in P&L to make good this 99 rupees by passing an entry P&L debit to capital and premium as a case may be. Now the question here is whether 56.210 will apply, because allotment price technically was 100. Founder put 1 rupee, 99 rupees got wrote off by adjusting P&L against the allotment price. Do you see any risk? Yes, no? It is, in my view, certainly a risk, because consideration you paid is only 1 rupee. You got share worth 100. Well, Companies Act may permit it. Just because it's permitted in Companies Act doesn't sort of absolve you from income tax law. So that few of them give this idea saying we can possibly do this. So that was the counter position. Okay, so far we talked about partly paid shares. And generally, whenever we are doing partly paid, we tend to do it as equity so that revenue is fairly clear. And there cannot be, like if it's CCPS, value could be much higher, etc. So this is the other structure which is being generally implemented in the market. The construct is something like this. Today I am going to allot CCPS or OCRPS. They will have a base conversion ratio. Say, I'll just give an example. Say 1000 rupees is the value per share. I'll allot 100 shares at 10 rupees each. Total allotment price is 1000 rupees. Shares will convert, 100 shares will convert into 1 share of 10 rupees. Okay. So I put 1000 rupees, I'm going to get 1 share of 1000, no problem whatsoever at the time of allotment. But the way the conversion terms would be written is that if certain conditions are met, the conversion ratio from 100:1 will say become 10:1 or 1:1. So when I allotted, it was 1:1. So 100:1. So I would have got effectively 1 share. If certain conditions are met, instead of 1 share, I'll end up getting 10 or 100 shares for that matter. Now the question is, how will the valuation and 56.210 sit in a situation like this? So in few cases, we have got a Monte Carlo simulation done, a valuation done, etc. It will be conditions, if they are realistic, then pretty much the probability of those conditions reaching will be minimal. With that, you may get away with a 56.210 trigger at the beginning. It's a little on the, it's a little on the gray side compared to the previous one, but this is like quite prevalent actually. And again, other thing is from 56.210 perspective, till the time there is conversion, there is no risk per se, because you are just holding on to the base share. Okay, this is a cleaner way to do wherever possible. Just give a simple example. Here founders are 20%, investors are 80%. Okay, say it's a very simple cap table, suppose there's no other complication. I want the founder to grow or increase in terms of stake from 20 to 25%. So far what we are talking about is, I give extra shares that 20 becomes 25%. Same thing to achieve other way is, if our investors at 80, I can simply bring them down to 75. Correct now, because it is like relative valuation. Because founder's stake will be 20 in the company, say. 20 has to become 25%. All that I need to do is reduce the investor's stake. How do I reduce the investor's stake? Fairly simple. All of them will typically have a CCPS structure. I'll tweak the conversion ratio downwards. What was 1:1 conversion will become 1:0.9. With them coming down, effectively the promoter or the founder stake goes up. Clear? This is, I would say, the cleanest way to do, because from a 56.210 perspective, you didn't get any share extra. Whatever you were having, that was there as is. The relative value of that went up. Just because your relative value went up because somebody lost doesn't mean you need to pay tax. Clear? Now the challenges in doing the structure will be, many cases what happens is there may be equity shares. I cannot change the conversion ratio of equity share because it's already equity. I cannot do any of it. Those sort of cases, what we have typically implemented is, some shares you put it in an ESOP pool. Because ESOP pool usually in a startup would be notional, because nobody would have set up a trust and put the shares in this thing. So that will be like an escrow arrangement saying that whenever employee exercises, you give the shares to employees free of cost. Because it is given free of cost, there is no 50 CA implication, because it is a gift essentially from the perspective of whoever gives up the share. In fact specific, we need to see what option works. This is again another variant of all this CCPS, etc. So this is again same sort of a scenario, from 20 to 25 I want to increase. What is done here is I allot bonus shares to all the shareholders pro rata. If I am allotting bonus shares to all the shareholders pro rata, there is no 56-210 issue, because everybody's ownership continues to remain the same, pre or post bonus, going by the Sudhir Menon decision of Bombay High Court. Clear so far? The terms of the CCPS would be something like this. If I convert today, they will convert 1:1. If I convert after 1 year or 2 years, whatever that could be, depending on certain condition, the conversion may be I'll get either more share or less share. So this is open to everybody. So it's like something like this, like a lottery. Today I've given you 1 share. That 1 share may become 1 share if you convert today. If you leave it for a year, depending, or 2 years, depending on condition, 1 may become 2 or it may become 0.5. Now the question is how the conditions are done, etc. I'm not sort of getting into that. Here, whoever has faith in the company can take a call to sort of hold on to the conversion option without converting it today, such that what happens is eventually if the conditions are met, the stake effectively increases from 20 to 25%. Here again, the point here is when the shares were allotted, it was all the same for everybody. Invariably, few of them took a call to convert, few took a call not to convert, and not to convert has led to an increase in value. So from a 56-10 standpoint, this also seems reasonable. Okay, with this, I'll sort of conclude. Okay. Thank you. Any queries? Was it too much or too fast?
So you handled the most difficult session in the most befitting manner, because normally post-lunch session itself is a startup. That's why you kept this program as a startup. But I think you have ensured that all of them are awake. Another big thing. So they silently did not answer a question. Too fast or slow, so they just clapped so that we don't know the answer for the same. Thank you for an excellent session. Really enjoyed. I request Priya Kannan to hand over the memento to speak. Amit, can you go to the stage, please? Thank you. So thank you very much. So your session also has ensured that we don't have a break for tea, because you have ensured that there is enough wake up is always there. So also we have the most senior advocate, Mr. Sridharan sir, is also has joined us live. So thank you very much, sir, for joining us. So before we start the session, a small introduction about Sridharan sir, even though most of you will be already aware of him. He holds a degree of mathematics in Madras University as well as a law degree from Delhi University. Besides, he is also a qualified chartered accountant and cost accountant. He is a founding partner of, so whenever we think of indirect tax, we always think about Lakshmi Kamar and Sridharan. So therefore, he's one of the founding partners. So it goes without saying they are leading in indirect taxes, anti-dumping and WTO laws. So he's in practice since 1983. He has delivered many lectures in direct tax laws and direct tax at various prestigious institutions and professional institutes. With his few words, I welcome Sridharan sir. Sir, over to you, sir. Thank you very much for joining virtually. So,
good afternoon to all of you. I am audible and visible, sir?
Yeah, very much. Both audible and visible.
Okay. I was told there was a small joke exchange between Mr. Govind Swaminathan and Mr. Chidambaram. Mr. Chidambaram was arguing in one court and Mr. Govind Swaminathan was arguing in another court. And they could hear because Govind Swaminathan's voice was loud and booming. Okay. So Mr. Chidambaram said, we could hear you when I was arguing my case. He was telling Mr. Govind Swami. So Mr. Swaminathan, it seems, said, I never knew I'm so sound, he said. There may not be light in what I'm saying. Let's see whether it's sound at least. Okay. I'm told my session is for about 90 minutes till 5:15, including question and answer session for 15 minutes or so. Is it so, sir? Roughly?
Yes, sir.
Okay. All right. Okay. I must, before I begin, I've been coached by my colleagues in this topic. Okay. If I get into difficulty, I'll request my colleagues Sriram and Dinesh to help me out. Okay. The whole idea is to communicate to you all what I believe is the. Let's go with this slide. First slide. Yeah. Share screen, no? I'll go to the next first slide. Huh? Screen is visible, sir?
Yes, sir, very much.
Yeah, visible. Go to this. Before we go into this relevance of domestic law and
So we are seeing your email screen, not the PowerPoint.
yeah, screen is clear.
No, your mail screen is there, not the PowerPoint.
Okay, just 1 minute. Just wait for 1 second because I'm not good in these things. I asked an expert to help me, so he's next to me.
Team
It's now there, sir. Now
the Zoom screen is now visible. Yes, sir.
Now, sir, no.
Yeah. Now your PowerPoint is visible.
Thank you. Okay. Before we go into the minute details of some of the topics which were allotted to us, I'd like to give a background of how this whole problem arises. What is this treaty and interpretation of that? Okay. And I'm not going to cite you Azadi Bajao Andolan, etc. I believe you all are experts on this. Okay. So I will try and explain what I think is a fundamental concept underlying this. And thereafter, we can always apply the answer, find answers to any of these questions. This problem of plurality of laws being applicable to a transaction is nothing peculiar to income tax and nothing peculiar to income tax at national level. Even in stamp duty, which is levied by various states, just take for example this case where you signed the document, properties in Delhi, you signed the document foolishly in Bombay, and then take it to Delhi. The Bombay Act will say, Bombay Stamp Act will say, if the document is signed in Bombay, you please pay stamp duty here. The Delhi Stamp Act will say, if the document signed is outside Delhi, is brought to Delhi and relates to property in Delhi, you have to pay stamp duty in Delhi also. I repeat, properties in Delhi, the document relating to the property is foolishly, I've said used foolishly for a reason, is signed in Bombay. Then Bombay Stamp Act will say all agreements signed in Bombay, if they fall in the schedule, you have to pay stamp duty in Bombay. Ultimately, you have to register the document. The document will be registered only where the property is located. So you take the document to Delhi. Delhi authorities will say, since the document relates to your property situated in Delhi, you have to pay stamp duty in Delhi also. So I'm giving an example of purely a tax which is payable to a state, which can have this problem. This problem is perennial in sales tax. And it used to happen really. I'm talking about pre-1950. The goods are in Bombay, contract is signed in Calcutta. Bombay authorities will say, please pay sales tax here because goods are here. Calcutta authorities will say, please pay tax there because agreement is signed. So dual taxation is possible, multiple taxation. In fact, more simpler example would be a biscuits packet is sold in a moving train. Okay. So it's, let's say, from Madras to Bangalore. Okay. Then you have to pay sales tax because packed biscuit is sale. Which state you will pay? Whether you will pay to Madras, Karnataka, or you will find out where the particular spot when the particular customer has purchased the biscuit packet, the train was passing. It's a nightmare. This happens even in criminal law. Suppose pickpocket is done in a moving train. Which police station you have to go? Okay. Problem arises in international criminal law, mid-air hijacking or passenger misbehavior in international flight. All these problems arise. If I look at you at the last 2 lines in this slide, conflict arose even prior to the modern income tax law because laws are territorial in nature. Each law, state of Tamil Nadu will make laws for the state of Tamil Nadu. India will make laws for the state country. So even in income tax, prior to independence, we had this problem. Pondicherry Railway Company was a French company incorporated in France, but Rail Track was all over British India. It was asked to pay tax to British India also on this railway fare earned from Trichy. Anglo-French, a French company having operations in Madras, buying and selling of goods, etc. Karimbai was a case of an Nizam of Hyderabad lending money to a borrower in Bombay, whether it is liability of income tax in Bombay. So this problem of same subject matter being affected by more than one tax law is applicable to tax laws and any law. I'm going to a slightly different topic. And this passage I took from a book on double taxation, and I found this book puts this nicely. The 4-5 examples given here are each country, I'm not saying in the wrong sense, each country greedily or otherwise describes the source of dividend or source of income in different manners. For example, dividend income, one country says source of dividend is in India if the company is a resident of India. UK may make a law that dividend declared anywhere is taxable in UK if the source of the profits are in UK. A third country may say dividend income will be liable to tax if the shares of the company share register is maintained in that country. So one dividend income, all of them say if the source of income is within my country, I will tax you. But the trick lies in each country defining the source in different manners. In this dividend example we have just now said, one says if the company is resident in India, I will tax the dividend income declared by it. UK, I'm hypothetically saying, will say I will tax it if the source of profit in UK, the company may be anywhere. Or third country may say if the shares register is maintained in that country, we will tax you in that. So the various examples of various types of income, for example, salary income, where the employment exercise, where the contract is signed, where the employer is located, where the payment is received, all can be there. So even in types of one income, if various countries define the source of income in that country in a different manner, and boldly assert, I will tax only source within my country. The trick is in how they define the source. It can lead to plurality of taxes. It's an old judgment of household lords in De Beers case, and I want to emphasize this for a very interesting point. It's a judgment which I like very much. De Beers was a UK company incorporated in UK. Sorry, my apologies. De Beers was a company incorporated in South Africa, where the diamond mines, etc. were there. But all the directors were Englishmen located in England and controlling the company from England. UK income tax law says a resident of that country of UK has to pay income tax in UK. I repeat, UK law said resident of UK has to pay income tax in UK. But there was no definition of a resident, particularly for a company. So De Beers was asked to pay income tax in UK as a resident of UK. So De Beers argued, sir, I am incorporated in South Africa. I am a company. I am a resident of South Africa. In a very interesting judgment rendered in 1905 or something, the House of Lords said, De Beers is a resident of UK. Kindly note this. House of Lords said, De Beers is a resident of UK. And why did they say? It said, unlike an individual who can eat and sleep, company cannot eat and sleep. But analogy of individuals can be imported for deciding the residence of a company. The House of Lords concluded that wherever the business is effectively managed and controlled, where the central management is located, that's the country of residence of the company. So UK judge-made law said, when there was no definition of residence, that place where the company is controlled would be the country of residence of the company. Already it is incorporated in South Africa. Okay. It is not incorporated in England, but we assume directors were there and managed from UK. So House of Lords said it is resident of UK, and House of Lords says the law in this country is well settled in Calcutta Jute, which was itself in 1890 or so. I want to emphasize this point at the cost of repetition, that UK judgment De Beers was delivered at a point of time when there was no statutory definition of residence in that country, in that law. And then, as a judge-made law, they said this is a natural meaning to decide the residence of a company. On the other hand, I'm not good in these things. I understand this. You may correct me if I'm making a mistake. Okay. US always believed that company is a legal entity. It's a creation of law, and therefore company can be resident of the country where it is incorporated and then nowhere else. I repeat, US took the view company is an artificial person created by law and therefore resident where it is incorporated. That's the US view. Now you straight away have two conflicting views of residence. UK saying where it is controlled and US saying where it is incorporated. Let us assume South Africa also has a view similar to UK, USA. So this De Beers will be a resident of South Africa, simultaneously a resident of England also. And both will be taxed. Therefore, you need to double taxation. You all know this jurisdictional double taxation, dual residence. That is in this De Beers is taxed in South Africa as a resident. It is taxed in UK also as a resident of UK. Then a resident in one country and source in another country, we know that resident source conflict. Okay. Then economic double taxation, two different taxpayers treated on the same income in two or more countries. We saw that slide on different sources, countries defining the same income as sourced in the country by different formulas. Dividend, we saw that. So this problem of plurality of source-based taxation also can arise. This is the leading for double or multiple taxation. I was arguing a case before my Lord Justice Devdar in Bombay High Court. Then he asked me, Sridharan, do you have double taxation avoidance agreement in service tax or GST? Do you have double taxation avoidance agreement in customs? I said, sir, fortunately, I'm told there are about 1,300 treaties in income tax. If you had to have double taxation avoidance treaty in customs, hundreds and hundreds of commodities, it will be a nightmare. We don't have generally a double taxation avoidance agreement in customs for the simple reason most countries levy tax on import of goods, levy custom duty and import of goods. So therefore, if the product is exported from USA to India, India alone levies custom duty on import. Normally, US doesn't levy custom duty on exports. There are some exceptions. Since why I'm giving this example of custom duty is all countries follow the uniform principle of taxing the goods in the country of import. Similarly, in service tax and GST, broadly speaking, we tax in the country where the consumer is located. Okay. And therefore, since there is only one single place where you will tax it, double taxation is avoided, multiple taxation is avoided. So you don't need to eliminate double taxation through the medium of treaties in customs or GST or service tax. So now I want to pose a small question. Anybody can answer this. Suppose all countries have identical income tax law. Will the question of double taxation arise? My query is clear. Mr. Krishnan, I think Mr. Krishnan is on the line now. So my query is, if all countries have identical income tax law, will there be a problem of double taxation? I told you in customs, all countries levy custom duty at the time of import, and therefore double taxation is avoided. I want to translate this into a query. If all countries adopt identical income tax law, will there be double taxation? Anybody can answer? Dinesh, my colleagues Dinesh and Sriram. Or sir, you can also answer, sir. Anybody can answer. I'm not able to hear. Sir, I'm not able to hear, sir.
That is already answered there.
Yeah. Can you pass? Yeah. Can you say, sir? I'm not able to hear. Yes, sir.
So the answer is already there in the slide.
Oh, okay. I know that. I know that. I at least wanted you to. You
See,
can
the
tell me, sir.
problem- See, the problem with me is Prasanna nicely charged. So I always used to ask only questions.
Yeah. So I'm used to accounts book where the answer is also given, because I won't be able to solve most of them. So I will immediately see the answer. Maybe I fail in the exam. That's a different matter. Okay. So as is there in the slide, no double taxation will arise if all countries tax only on the basis of residence or not on the basis of source, and most important, all of them on identical definition of residence. If, for example, we saw USA say you are resident of USA, but company is incorporated in USA. UK says you are resident of UK if the company is managed in UK. Both of them have identical laws. I will tax only a resident. I will not tax a non-resident. And rate of tax 10% on salary only. But the trick lies in UK saying you are resident of me, USA saying you're resident of me. So it is not enough. If the rate and all are identical, there should be a unique definition of residence and non-overlapping. Similarly, if all countries tax only source of income within that country and not based on residence, and definition of source should be unique without overlap, then there will be no double taxation. But that's wishful thinking. It will never happen. It will never happen. Okay. So the problem is, because each country proclaims that I'm taxing source in the country. Each country proclaims that I'm taxing residents in the country. But the trick is they define source in multiple ways. So therefore, the double taxation can be eliminated only through tax treaties. This is the background I wanted to give. Even here, if all treaties are identical, maybe problems can be reduced to a great extent. But no two countries negotiate an identical treaty. Each have their own pressures and pulls. Okay. And therefore, when they negotiate a treaty, they always have their own interpretations of it. As a student of law, the question would be whether you can interpret one treaty in the light of another treaty, or language used in another treaty. Answer can be yes as well as no. Okay. Generally, courts, it is like saying you interpret Maharashtra Sales Tax Act based on Bengal Sales Tax Act. We don't do that because each state is a sovereign in itself for the purpose of sales tax. So you don't interpret Bombay Sales Tax Act based on Bengal Sales Tax Act. You don't interpret Indian Income Tax Act based on UK domestic law. Similarly, treaty with India and UK will not be interpreted based on India and USA. There can be an argument. On the other hand, the view is if the consistent practice is emerging about the thought process of one of the treaty partner from the treaty entered into by various countries, then you can say this is the meaning to be attributed. The treaty logic, as far as one country is concerned, can be deciphered from string of treaties it entered into. Okay. The judgment of the tribunal special bench in Raymond case, I am told, which suggests something. It's plausible also says that. So individual comparison may not be possible, but if we can show from a combined reading of string of treaties entered into by one India, the other countries, then you may say there's a treaty parlance as far as Indian executive is concerned, and you can decipher a common meaning from that. That's what. Otherwise, each treaty is independent in itself. Yes. We say there's a conflict of laws in a private international law. Clause Ogle explains it beautifully. If India gives one meaning to a particular term in the treaty, the other treaty partner gives another meaning to the treaty, that is not called conflict of law in the international law sense. Conflict of law is seller is in UK, purchaser is in India, okay, whether the contract of sale will be governed by UK law or Indian law. That's what we call conflict of law. The matter will be governed by one of the two laws, which law will apply. Similarly, marriage performed in India, but the couple are staying in Australia, they will be governed by the place where the marriage is performed or where they reside. That's a question of conflict of law. That's not the principle we are concerned with. In other words, if the treaty is interpreted by two treaty partners differently, it is like contract being interpreted by the seller and purchaser differently. The question as to how you will interpret the treaty in the light of domestic law, we'll be discussing little later, because 3.2 is one of the topics to be given to me. I will deal with it little later. The next line is more important, and that is this, what we call stand and deliver arguments. And that is very common in India. I have seen hundreds of cases where the senior counsel is briefed at 9:30 in the morning on a particular topic, and the matter is to be argued final hearing in the Supreme Court. What is the depth of analysis that can be communicated to the senior counsel at that time, and what he can contribute to the court? So what happens? You look at the section, without looking at legislative history, etc., give a prima facie interpretation, and court either accepts or rejects. That's the problem in the country. As Benian writes, my book is meant for busy judges and even busier lawyers. Why I'm mentioning this is, if somebody simply looks at the treaty and applies common sense interpretation to the word used in the treaty, is bound to lead into errors. And the errors can be sometimes very serious, as we'll be seeing shortly. The treaties, as is well known, are not drafted in pure legal language by legal draftsmen. It is by diplomats and bureaucrats and economists. So there's a treaty style of writing. And the treaty style of writing is percolating right from League of Nations times in the 1920s. So many of the terms have a conventional understanding. Okay. I repeat, many of the terms have a conventional understanding. You must interpret the treaty in that conventional sense. You may ask how anybody can find out such an elusive concept like a conventional sense. There are materials for that. Commentaries, articles, etc. We will see that. And failure to give importance to this historical perspective has led our Supreme Court in Kulandangal Chettiar's case to commit an error which is somewhat fundamental in treaty interpretation. The Kulandangal Chettiar case is somewhat peculiar and very interesting. That was a person who was an HUF. He had some plantation in Malaysia. Okay. Indo-Malaysia Treaty did not have an article similar to Article 13 of OECD model. In other words, there was no capital gains clause. The clause related to Article 6, income from immovable property and agriculture, was there. It is not clear in the judgment of the Supreme Court, but if you look at the tribunal judgment, which ultimately went to the Supreme Court, it appears to be a case where the estate itself was disposed of. And there was a capital gain in that sense. First question was whether when Article 13 related to capital gains is not there, and Article 6 is related to income from immovable property, whether income on disposal of the estate would be governed by Article 6. Somebody could have said capital gain is not there in the treaty, therefore outside the treaty. Somebody could have said it will be governed by Article 21. 21 also is not there. Mr. Ramamani, the legendary Mr. Ramamani, argued before the tribunal that income from property can include capital gain from the property. Tribunal accepted that. That's a different controversy. In other words, capital gain made on transfer of the Malaysian plantation, tribunal held to be income from property governed by Article 6. Matter reached the Supreme Court. Supreme Court took the view, Article 6 of Indo-Malaysian Treaty said, it may be taxed in Malaysia. Supreme Court therefore concluded that even though assessee is a resident of India, since Article 6 said it may be taxed in Malaysia, Malaysia alone can tax it and India cannot tax it. You open up any book on double taxation commentary, it will say this is an howler. Because we all know double taxation treaties generally say source country will tax it, subject to restrictions, etc. A resident country will also tax it because based on global income and give credit for a taxes paid in Malaysia. But our Supreme Court took the view that India cannot tax it at all. So every commentary says this interpretation is doubtful. All this problem arose because the word may be taxed was not understood in a conventional historical sense, the background which these terms appeared in the treaty. What we call stand and deliver judgments. I don't know, I was appearing in a Kerala High Court matter last week. And one judge said, Sridharan, these are called Digambar arguments, it seems. Digambar Jain, I'm told. Jains who don't, the rishis don't wear clothes. So if you make an argument without any support, bald argument, Kerala judges call it as Digambar arguments. So it must be maybe tax, my lords. Somebody must have said maybe tax means in this sense of conventional sense. Somebody has said it's a contraction, maybe tax means can tax in Malaysia and not in India. That's where the problem. Why I'm referring to this is has led to a series of subsequent amendments. That's the reason why I'm spending time on this. Historic equivalent is important, especially in case the terms have acquired a well-defined, accepted meaning international treaty practice. The next question, of course, is while interpreting a treaty, if foreign courts are given a meaning, normally they are not bound. But having regard to the position that international treaties have tax treaties have a common flavor, having regard to the reputation of the other court, you must give an interpretation which marches hand in hand with the interpretation given by other country. That's what Clause Vogel also says. Okay. Sorry. My request to the audience is to bear with me for next 3-4 minutes. Okay. And in my humble submission, whatever I said so far is somewhat familiar. Okay. What I'm trying to present now is my understanding of the law. And I believe that this is slightly unique and slightly original. Okay. I'm not saying right. It's for your understanding and consumption. But you will approach this matter in the light of what I'm going to discuss just now. After this next 5-6 minutes of discussion or 10 minutes of discussion, we may be able to solve few questions, whether by signing treaty, India is giving up its sovereignty, sovereignty is being abrogated to the other countries. Then what this principle that treaty cannot create liability. Okay. Then the principle that domestic law is beneficial, then you can go to domestic law. If treaty is beneficial, you can go to treaty. Those 2-3 fundamental questions, we may be able to understand and answer with clarity, not based on case law, but with clarity and first principle. That's the aim of this session. And in my humble opinion, what we are going to discuss the next 10 minutes, maybe the core of this 1 hour of session with you all. I now want to refer to a custom judgment gramophone manufacturing case. Very interesting judgment by my Lord Justice Chinnappa. He's a very learned judge, a brilliant and a learned judge. And I'm going to explain the facts of this case in some little detail. Gramophone was the HME's company's name was Gramophone, and HME was the. On those days, we had this long players, gramophone records, and also audio tapes. Then number of these Hindi film songs, etc., used to be pirated. Okay. And gramophone was losing lots of royalty. Okay. Nepal is a landlocked country, and imports into Nepal have to come through Calcutta. Okay. So India has Indo-Nepal treaty is there. Otherwise, also being a landlocked country, as per convention, India has a duty to permit access through sea through Calcutta port. So these audio tapes used to be imported in Calcutta for transit to Nepal. And they are not meant, supposedly not meant for sale in India. Gramophone claimed that the tapes being imported for sale or display in Nepal are pirated. They had the copyright in India. These have been illicitly copied abroad and are being taken to Nepal officially. Actually, after it crossed the Calcutta port, it is smuggled into India. Okay. So Gramophone wrote to customs saying, please confiscate these goods. Don't permit them to be imported, transited to Nepal. The other party argued, sir, these goods are not meant for India. They only transited through Nepal, transited to India to Nepal. Therefore, Indian customs cannot confiscate. Confiscate why? On the ground, it violates copyright law. The matter went to the Supreme Court. The Supreme Court first said there is no explicit domestic law made by Indian Parliament dealing with this aspect. Kindly note that. There is no express domestic law made by Indian Parliament dealing with this aspect. Point number one. Point number two, Supreme Court noted that there is a uniform, customary, international law discouraging and preventing piracy and protection of copyrights of people. There's an accepted convention throughout the world without any ambiguity in it. It is not as if somebody says patent is monopolistic, should not be granted. Some countries say patent should be granted to protect the inventor, etc. As far as copyright is concerned, consensus is the author has to be protected. Therefore, Supreme Court said there is no domestic law. There is a uniform international law. Therefore, it will automatically apply to India, even without a formal legislation by Indian Parliament. And these cassettes being pirated are liable for confiscation if they are indeed pirated. This is what the principle laid down in gramophone is. And I'll read these slides once again for a minute. Kindly pardon me for repeating. Uniform custom interpretation law automatically is part of municipal law, even without an express legislation. However, in case of conflict, municipal law will prevail. In case of conflict between what? Domestic law and international law. Enacted domestic law and international law, enacted domestic law will prevail. Kindly note this sentence, very important. Enacted domestic law and international law, there's a conflict, enacted domestic law will prevail. If Indian Parliament makes a law to implement international law, then you give an interpretation so that the Indian law is conformed to the international law. Third situation is different. That is, there is an international law. India has made a, Parliament has made a law. Some ambiguity is there in the language of the Indian legislation. Construe it in the light of the international law. Therefore, if there is uniform international law, it becomes part of municipal law of India without need for legislation. That monolistic and dualistic principle. If there is no uniform international law, this question doesn't arise at all. No question. The next slide is also equally important. Having understood gramophone, we'll now look at this. We saw the stamp duty case, sales tax case, and Pondicherry case, etc., etc. All these point out that as of now, international tax law permit so-called extraterritorial legislation. I repeat, current state of international tax law, income tax law, permits extraterritorial legislation. In other words, India can tax its resident on its global income. That's an accepted international law. Also, India can tax foreigners if they have source of income in India. So an American comes and works in India, employment is in India, India can say, Mr. American, you are not my citizen or resident, but you are earning income in India, I can tax you based on source being in India. Similarly, if a software engineer, resident of India, earns money from USA, India say, I will tax you based on residence. Why am I emphasizing this is, contrary to gramophone case where international law said piracy should not be there, and there's accepted copyright law world over, in income tax, accepted norm is countries can tax residents on the global income and countries can tax non-residents on the source within the country. In other words, international law tolerated and permitted and accepted as a norm double taxation on this basis. Therefore, when I said uniform international law is there, in copyright case, automatically it becomes part of Indian law without any little finger being moved by the Indian Parliament to make it part of law. But in our income tax, each country is sovereign itself and tax the maximum it can. There's no question of uniform international law. If at all, uniform international law is to permit double taxation. I'm digressing a bit. I want to give an example of uniform international law. For example, all countries agreed that India includes territorial waters of India. England includes territorial waters of England. What can be the length and breadth of territorial waters may vary. Generally, not 12 nautical miles. Nobody ever disputes that a country refers to main landmass only and does not include territorial waters. That used to be a dispute 200 years ago. So that territorial waters is forming part of the mainland for all purposes is an yet another example of uniform international customary law. If you apply it to our income tax context, uniform customary law is multiple taxation, double taxation of resident on global income and sources of income in the country is permitted. I am digressing slightly and I'll be coming back to a point in a minute. Entry 14 of list 1 of the 7th schedule to the Constitution says Parliament can make law for entering into treaties. Parliament can make law for implementing the treaties. I repeat, Article 240 of the Constitution says Parliament can make laws for subject matters mentioned in list 1. And one of the subject matter is entering into treaty and implementing of treaty. When India enters into treaty, double tax and award agreement with France, it is not based on entry 14 of union list. Entry 14 only says Parliament can make law for entering into treaty. Actual entering into a treaty by the executive is not directly related to entry 14 of the Constitution in list 1. Just keep this technical point in mind. Entry 14 in list 1 enables the Parliament to make law to enter into treaty. Parliament can make law for implementing the treaty. If you therefore see the next line in this slide, is section 90, subsection 1 and 2 relatable to entry 14? Yes, maybe. It may be power to levy income tax itself can give the power to enter into this. Otherwise also. So in other words, section 90 of the Income Tax Act may be traced to power of the Parliament to make laws to enter into treaties. Okay. Actual treaty is not entered into in terms of entry 14 of this. That will be based on section 90 of the Income Tax Act. Section 90 subsection, you all know it. I'm just going to read it for a minute. Central government can enter into treaty for relief of tax, avoiding double taxation, exchange of information, recovery of income tax. They say, Her Majesty's courts do not exist to recover the enforced tax law of other countries. To file a suit, if government of India files a suit in UK, saying such and such person of UK owes Indian income tax and he has a property in UK, I'm enclosing the assessment order of my assessing officer as an evidence. Please pass a decree against him. UK court will dismiss the suit, saying, I am not existing here to recover your taxes. I'm existing here to recover Her Majesty's taxes or His Majesty's taxes, as the case may be. Okay. To overcome that, countries can enter treaty at 91, saying that we will cooperate with each other to effect recovery of tax in the other jurisdiction. That's what 91 is. 90 subsection 2, introduced in 91 or so, retroactive 72. Provisions of this act shall apply to the extent they are more beneficial to the assessee. Of course, GAR provisions were introduced later and said this will not apply if they are considered the guard provision. But 90 subsection 2 says the provisions of this act will apply. That is, income tax should apply only when it's more benefit to the assessee than the treaty. Therefore, if under the treaty, the tax rate is 10%, under the domestic law, tax rate is 5%, then only income tax act will apply. If under the domestic law, the tax rate is 20% and the treaty is 10%, he need not look at the domestic law. He can look at the treaty. That's what 90 subsection 2 is. Can I ignore the first line in this slide and go to the next line in this slide? Dinesh, you are on the line.
Sir, you can go ahead, sir.
Go ahead. Okay. Right. Question I am posing to you all is, suppose section 90 is not there in the Income Tax Act and Government of India has entered into treaties. So India has signed a treaty with UK saying interest I will tax at 5%. Section 90 is not there in the Income Tax Act. Under 915, read with 115A or something, rate of tax and interest is 20% of the Indian law. I repeat, India has entered into a treaty with UK. As per the treaty, India will levy tax on interest at 5% on the UK non-resident when he earns interest from India. Under Income Tax Act, the rate of tax on that interest income is 20%. And the question to you is, section 90 is not there in the statute book. What will happen? Can anybody answer?
One has to apply only the domestic laws.
Why, sir?
Because the benefit of treaty is not there, because the entire section 90 itself is not there. So the only question is go with the domestic law. There is no recourse under the act to reach the treaty.
But the government has signed a treaty with UK.
But
The facts I gave, you are right. Your answer is perfectly correct. Okay, I'm thankful to you. But I just want to reiterate. Government has signed a treaty with UK. Section 90 is not there. Then you gave the correct answer. But we'd like to give a better reasoning.
So in order to, let's say, to invoke the powers under the treaty or invoke the beneficial provisions under the treaty, there has to be an enactment under the act.
Correct. I will put it like this lightly. We saw if there is a conflict, kindly keep the mic with you. Kindly keep the mic with you. Okay. We saw that if there is a conflict with domestic law and the treaty, domestic law will prevail. Section 4, read with Section 5 of the Income Tax Act says, all residents, all foreigners will pay tax on this so and so, so and so. So in case Section 90 is not there, there's a treaty there. Section 4 and 5 are already there. It's a case where express domestic law is there, contrary to the treaty. Therefore, treaty is useless if Section 90 is not there. Therefore, as you correctly pointed out, Section 90 should be there. If Section 90 is not there, India may sign treaties. It's of no use, particularly because Section 4 and 5 of the Act impose a tax on this. Example of a domestic law being conflict with the treaty signed by it, therefore domestic law will prevail. Therefore, Section 90 is necessary. I don't know whether I'm clear, sir.
Right. Okay.
You can criticize it. I have no problem. I welcome it also. No problem. Okay. This is the point I want to convey to the audience. My approach is this: gramophone, double taxation is permitted by international law. If there's a conflict with domestic law and treaty, domestic law will prevail. If therefore, if 90 is not there, people will be subject to Section 4 and 5 and treaty will be useless piece of paper. Because 90 is there, okay, the conflict between domestic law and treaty no longer exists and 90 governs the matter. In other words, despite the treaty, you are eligible for relief, whatever section 90 confers. And if 90 doesn't confer relief, you are in trouble. That's my approach. I may be wrong. Therefore, I was saying, sir, you see this slide, Companies Profit Surtax Act was similar to Income Tax Act. When enacted, it did not have provision similar to section 90. In 1965, section 24 was added by Finance Act 1965 in the Companies Profit Surtax Act, providing provision similar to 90. I repeat, Companies Profit Surtax 1964 is nothing but income tax on profits of the company. In 1964, as enacted, did not have provision similar to section 90. That amendment was made in 1965. Thereafter, Companies Profit Surtax Act also is eligible for relief provided by double taxation treaties. Absent that, there's a problem. That is why we say equalization levy is under Finance Act 2016. Finance Act copies every provision in Income Tax Act, like income tax return filing, this, the dunya bhar ki, all these are. But section 90 is not there. Question therefore will arise, if equalization levy is a tax imposed on the Finance Act 2016, and there is no provision in Finance Act 2016 similar to 90, even if India enters into double taxation treaty, because 90 is not there, you may not get relief. That's the point I wanted to emphasize. Does section 90 extend to tax other than income tax imposed by some other act other than income tax? For example, Black Money Act. We all know it's income. It's a tax on income only. Can we claim relief on double taxation treaty because income tax? There may be a problem. May be a problem. I'm not saying there is. Okay. I'll be dealing with this equalization levy little more closely, because when he asked, one of the topics that was asked specifically is interplay between international law and domestic law. Therefore, I'll touch this. The next line in the slide is in a lighter vein, because I achieved my main purpose of troubling you over gramophone and section 90, etc. Okay. What is the basis? We say, no, sir. Treaty cannot create a charge, cannot create a levy. First point is, if treaty is beneficial, we can rely on the treaty. Domestic law cannot be thrust on the assessee. Section 90 subsection 2 says. But which is a section in the Income Tax Act which says treaty cannot create a liability? If under the treaty rate of tax is 20%, on domestic law rate of tax is 5%. We all say treaty can give benefit, cannot create a liability. Why do we say so, sir? Can anybody answer?
We always understood that treaty is only a distributive rule. So it allocates the taxing rights between the countries.
Sir, you are answering one jargon by another jargon, which I am very good at without answering. Kindly try again. Your answer is correct. Kindly.
There are occasions where treaty also imposed a charge. Say, for example, India-Australia treaty until they recently renegotiated with the free trade agreement. In Tech Mahindra case, where the entire aspect is on the charges created by the treaty on the fees for technical service. There are occasions where I do agree that treaty can impose a charge.
No, treaty cannot impose a charge. Australia refused to agree to the interpretation in that particular instance. Otherwise, now instead of making them issue a circular saying we made a mistake, but they amended it. That's okay. The answer is simple, sir. As you rightly said, if there is a conflict in domestic law and treaty, domestic law will prevail. It's for the same reason, nothing beyond that. It's a simple case where there's a conflict in the treaty and the domestic law prevails. 90 subsection 2 says act will apply if it is more beneficial. It doesn't say the reverse. Reverse flows from the principle of gramophone. If there's a conflict in domestic law and treaty, domestic law will prevail. That's the reason why I want to give this example. Okay. And now I was joking with Justice Ishwar, who is a master in the subject. Okay. India entered into treaty with USA, and Article 12 or whatever the article very boldly said, way back in 1960s, 70s, or whatever it is, USA permitted India to levy income tax and royalty on trademark and license fee, royalty and license fee and trademark, copyright, etc. Okay. So treaty between India and USA says, if the trademark owner is in USA, licensee is in India, and the licensee pays income to by a royalty to the US resident, tax at 10% can be levied, provided in the treaty. When they went to collect that money, that fellow says, sir, under domestic law, pre-1976, there is no levy, because at that time we did not have 916 and 917. And business connection was held not to cover this. Therefore, the fellow argued that there is no levy under the domestic law on this transaction, that India and USA signed a treaty and India was granted right is not relevant. I was joking with Ishwar, sir, where the US fellow should have told the government of India, no, that's there is no provision of domestic law, writing and signing Article 12, but please amend your domestic law. Then he says, why will they tell? I mean, I was only pointing out way back in 80s how the knowledge of the tax department, tax administration was also somewhat on a learning curve only, and other countries exploited it. Next example is this. Again, India included continental shelf in the treaty. US included continental shelf. So when oil companies were doing drilling and rigging, drilling using the rigs in the continental shelf, India wanted to tax it based on the treaty. They said, under your act, India includes only territorial waters. It will not apply. So these are two examples where treaty provided for India to taxing rights, but we didn't have enough provision in the domestic law, and therefore we couldn't do anything. But that's purely a matter of lighter vein. But the true answer is, treaty cannot create a liability, because that's a case of a conflict in domestic law, section 4 and 5, read with the appropriate section, and the treaty, and therefore domestic law will prevail. When 90 subsection 2 says, to the contrary, we will apply the act only when it is beneficial. Because act says so, we will do so. Okay. So, sir, I don't want to explain this equalization levy in that detail, except for saying whether it is a direct tax, indirect tax, is a matter of doubt. Whether it's a treaty override, it's a different aspect. But question for our discussion is whether treaty signed between India and US or any other country under the Income Tax Act will be good enough to grant exemption from payment of equalization levy, on the contention that equalization levy is in income tax. Article 2 says taxes of similar nature also are covered. According to me, there may be a doubt. Firstly, somebody may say equalization levy is not income tax. Okay. Even if it is put in a separate act, and there is no provision in that act for entering into treaty like section 90, and therefore you may not get the benefit of treaty protection of equalization levy. It's a matter to be argued. In fact, last week only we were arguing to a special bench whether treaty benefit will apply for dividend distribution tax. So we don't know what will the outcome. Okay. So judgment is reserved. Okay. So I have already explained how in 1965 for Companies Profits Tax Act, Wealth Tax Act, Finance Act 65 amended this. Okay. The next, these are all now very routine slides, not great complications. Because this is one of the topics I'm asked to comment upon, discuss with you all. how far the commentaries of OECD are relevant, binding, etc. If you are a true student of law, you will say every knowledge and every information is welcome. Anything which helps me to understand the meaning of the terms, I'll always look at it. Okay. But all courts do not take such a charitable or liberal view. Sometimes they feel there is an act by the parliament. I'll read the act and give my meaning. I'm not concerned with the meaning which the minister has said, or speaker has said, or CBDT has said. That's one view. Another view, that depends on the individual judge. Okay. Some judges feel, no, all have a purpose, we'll read with the rest of the documents. So even on OECD commentary, the Kolandangal Chettiar, at least the High Court, Justice Raju, was a very strong judge and was extremely intelligent and was very confident of his skill. He said, I don't need to look at these commentaries. I need not understand my law from that. He also gave a view. The Indo-Malaysian Treaty is completely different, both in terms of language and structure of the OECD. Therefore, I will not look at the OECD commentary. Therefore, meaning of the word may be given in the OECD, I will not follow. Supreme Court in Kolandangal also endorsed it. Because Justice Rajendra Babu also was completely confident of his skill and is also a very good Chief Justice. Okay. But an equal judges could have said, every bit of information which enables me to understand the meaning more completely, I will look at. That's what Justice Sri Krishna said in Azadi Batao, where he quoted extensively and said, this OECD commentary is indeed very material and relevant. In any case, this controversy is no longer open for any great debate, because Supreme Court in the engineering analysis have extensively read on and upheld favorably reliance to the OECD commentary. Because they say, forget about you, but the other treaty partner entered into a contract with you would have kept in mind OECD commentary and therefore entered into the treaty in the manner he has done. Therefore, it can be valuable to interpretation, plus for other reasons. Okay, so it now fairly settled. Till the time engineering analysis is overruled, review petition is pending. What are the grounds for review? I do not know. Okay, and otherwise we can take it as a fairly settled law. However, we must be careful. If the structure of the particular treaty and the scheme of the particular treaty is different from a general pattern of OECD, or the wording of the particular treaty are different from OECD, then the commentary may not be relevant. Commentary is not relevant. Commentary is not binding, not because it's irrelevant, not because it's incorrect, but it's not relevant to the topic. Okay. So OECD commentary loses its persuasive value, not because it's incorrect, because the subject matter we are considering are different. The language of the particular treaty in question may be varying from OECD treaty. For example, if you have a treaty without Article 8 at all, then what do? I'm told there are landlocked countries, therefore there is no shipping income. So there is no reciprocal arrangement. Therefore, there may not be Article 8 in the treaty. Will it be governed by Article 7? Will it be governed by Article 21? Will it be outside the treaty itself? Those matters, OECD commentary will not help. That's the limited observation I wanted to make of this. One other topic I've been asked to specifically discuss is applicability of Article 3(2) for okay. (3)(2), you all know, it's on the screen also. It says, any treaty entered into by the country and if it is not defined in the treaty itself, defined in the treaty, no question. It's not defined in the treaty, then you will go by the definition of that term in the taxing statute. If a term is not defined in the treaty, but is used in the treaty, then you will go by the meaning which the domestic of the country applying the treaty has assigned to it in its tax law. Even this is subject to the context. Okay. Because every definition is subject to your context. Even 3.2 is subject to your context. If not, any other analogous law. I don't think you can look at Prevention of Corruption Act definition for purpose of treaty. I'm giving a hypothetical example. Okay. Or definitely Industrial Disputes Act may not. Okay. But it may have a meaning in the sale of goods, which is general part of general body of law. It may be relevant. Okay. So that's what 3.2 says. The more important thing is coming from this. Section 90, subsection 3 of the Indian Income Tax Act was introduced sometime in 2003 or so. It said, if a term is not defined in the Act also, but is used in the treaty, what do you do? Article 3.2 says, if it is not defined in the treaty, but term is used in the treaty, you will go by the meaning given in the domestic law of the country applying it. But if there is no definition in the income tax of that, what do you do? The 90 subsection 3 says, government by notification can give a meaning to it. Okay. Then explanation 3 is that notification will be effective from the day the treaty came, not merely from the date of the notification. I am not too sure of the difference between explanation 4 and main section 93. I am told that there is substantial overlap between main section 3, subsection 3 and explanation 4. When this section was introduced, some of our friends at the tax bar said, sir, what has the government done? They can give any notification and therefore wriggle out of the treaty obligation and create a treaty override through notifications. I also agreed with them. But I didn't realize many times the court can give an interpretation of the treaty which is against the assessee. Okay. In Kulandangal Chettiar, fortunately, it was in favor of the assessee. Okay. It was equally gone the other way also. And then you are stuck. So, and the government cannot go to amend the treaty with the other treaty partner because that other treaty partner says, I am not concerned with your domestic law problem, you do it. Therefore, the initial assumption of people that 93 has been enacted by the central government, by the parliament, to benefit the revenue may not be fully correct. There may be stalemates created by the courts, surprise created by the court, maybe in favor of the assessee, maybe against the assessee. And instead of going back to the parliament, if you go back to the central government, they themselves may be able to carry out the amendment by this notification. So to brand this 90 subsection 3 is an executive flavored provision may not be fully correct. Okay. So far, as I understand, they have only been explaining what is the meaning of the term may also be taxed, may be taxed. Because that's the problem created with Kulandangal Chettiar. May be taxed in Malaysia means Malaysia alone can tax it. I mean, we've gone to an extent, I don't know whether it's there in this slide. SR Oil argued before the Bombay High Court and succeeded. It had a P in Dubai, and the treaty says may be taxable in Dubai, P is income. Therefore, it argued in India, you need not pay tax on the P is income based on Kulandangal Chettiar. Okay. High Court agreed also. That is, Bombay High Court took a view that SR Oil Limited, an Indian company, need not pay tax in India on its global profits. to the extent profits are accruing outside India to peace in the respective treaty countries, India cannot tax it at all. That any student of DTAs will say this is incorrect. 93 notification solved the problem. In that particular instance, solved in favor of the government because judgment law is not fully accurate. So the next slide is on static versus ambulatory interpretation. The term itself is a little ambiguous to me. Okay. But basically it means 3.2 says meaning it at that time. Okay. Indo-Australian Treaty says from time to time. Okay. Bombay Accord in the Siemens case, when royalty definition was there, and this has been followed by Delhi High Court and approved by Supreme Court Engineering, seems to suggest, following the Canadian judgment, that it will have the meaning at the time when the treaty is entered into. I want to give a small example. It's a judgment of the Supreme Court. Once before 1970 or so, I don't remember exactly when it was. State of Haryana is part of Punjab, undivided Punjab. Thereafter, state reorganization, Haryana was carved out of Punjab. Okay. Punjab sales tax rate is made by the Punjab legislation in 1948 or so, and it continued to apply to Haryana after Haryana got bifurcated, because all laws prevailing earlier will continue to apply in Haryana. Okay. Now, so Haryana became a state in 1966 or so, let's say. In 1972, Haryana wanted to amend this Sales Tax Act retrospectively for the period prior to 66. State was formed in 1966. Punjab Sales Tax in 1942. Amendment was sought to be made by Haryana in 1972. Hypothetical example. So argued that Haryana cannot amend in 1972 for the period prior to 90s. At that it was part of Punjab, and at that time Punjab legislature could have done it. Only do it. Therefore, Haryana legislature cannot do it. That's the argument. Supreme Court laughed and rejected the argument. The Supreme Court says, today this area is covered within the state of Haryana. Haryana state is legislating for its state only, and is legislating today. That it legislates for a period prior to its formation is not relevant. You have to see the legislative competence the day the legislation is being done. That's what the reasoning given to the Supreme Court. That's okay. But the humorous reason given by the Supreme Court was, we don't expect both Haryana and Punjab to merge, to become one state, to carry out the amendment and then demerge. That's impractical way of doing it. That's what court said. Similarly, if you say without any reservation qualification, subsequent amendments to domestic law can never apply, that's too much of a generalization. According to me, Canadian Supreme Court did make that too much of a generalization. Our Bombay Court applied too much of a generalization. And Bombay was followed in Delhi and instance approved by Supreme Court engineering analysis. The proposition is too widely stated to be accurate. That's what my view is. Okay. As Palkewala writes, the first SR has a predictable sequel. Okay. First SR, Bombay High Court took the view that profits of PE in Dubai will not be taxed by India under Indian Income Tax Act. What will the legislature do? Introduce 93, introduce an explanation, issue a notification, and then the contention is notification will not apply for the past. The tribunal specifically noted out that the Indian judiciary's judgment is contrary to international writing. Judgment tribunal did not say we'll ignore the Supreme Court and go by international writings. Seeing this conflict, legislature stepped in under 93, and therefore the notification issued way back in 2009, etc., will be declaratory and effective the date of the agreement. That's what SR said. The matter is still pending in the higher court. Sriram, we can stop here. We are running short of time, no? Sir, we have time or
You can have
for
5
question
more.
answers? I want to deal with MFN clause if possible, if you permit me.
Sure, sir.
Subject to time availability.
Sure, sir. You can have.
Huh?
Yeah, you can take it, sir.
We have about 10 minutes more now, sir.
Sure, sir.
Okay. This, my junior says, available in some commentary and therefore down. I have not verified it. It was Indian treaties about MFN clause in 13 countries, 13 treaties. 10 of these members of OECD and 3 are with non-member OECDs. Okay. And this is familiar in WCO also, that if you give favorable treatment in any member country, will extend it to all. Same thing, most favored nation. So it generally will say, India-Sweden treaty will say, if after entering the treaty, you enter into treaty with any other OECD country, giving relief to that other country, then you will automatically give it to me. That's what most favored nation clause is. For example, Indo-Sweden treaty says royalty will tax at 10%. Then India enters into treaty with Belgium, saying royalty will tax at 5%. Then, if there is an MFN clause in Indo-Sweden treaty, saying if with another OECD member entered into subsequently, give a concession that will apply to Indo-Sweden also. That's the easy case. First question in this is, after India enters into treaty with Belgium, is there any further step required by the government to say, I entered into Sweden at 10%, subsequently entered into Belgium at 5%, MFN clause in Sweden is there, I now hereby concede that it will be 5% henceforth. Suppose such a protocol is not issued, what happens? Answer is, obviously, it will be self-operative. There is no need for a notification separately to reiterate the obvious. In other words, once contract is signed, treaty is signed, without saying that MFN clause will be implemented by a protocol, there is no need for a separate notification. That's obvious. There is no problem in that. What is problematic is this part of judgment of Delhi High Court and Karnataka High Court, I think is correct. No problem on that. The difficulty is, if that's the problem in Slovenia case. I don't know, it's argued in the Supreme Court and you people must be up to date on that. That's slightly different issue. Let me take a hypothetical example. India-Netherlands treaty says, if you enter into treaty subsequently to OECD country and tax rate is on dividend is lower, it will apply to us, let's assume. India signed with Slovenia and to the other countries, agreeing with dividend at 5%. On the day India tried treaty with Slovenia, Slovenia was not a member of OECD. It suo motu went and became a member of OECD. Now, Netherlands people are saying, in our treaty between India and Netherlands, you said, if you enter into treaty subsequently with the OECD country, that benefit will give to us. India is crying, sir, I entered into Slovenia, thinking it is not a OECD country. Assassi is arguing that you should have been aware that Slovenia as a sovereign can go and get enrolled by itself as an OECD member. If you close your eyes, you open your purse. That's the argument. Okay. That matter is pending in the Supreme Court. Judgment is reserved. This may be a little controversial. But if MFN clause says that you enter into treaty subsequently, and without anything more, the benefit will apply, then there is no need for a fresh protocol or a notification. If they issue well and good, that's what Delhi and Karnataka correctly held. That controversy is different from Slovenia. Okay. And the last one was what I argued before Bangalore Tribunal, but the Bangalore Tribunal simply remanded the matter back without deciding this. And our clients, my colleague Sriram says, clients call from Belgium and saying, sir, legal question court will not decide, we'll ask the ITO to decide, sir. What is this, sir, your country? This is little interesting. And I request you all to, this given by my colleague Ashish Karandi, otherwise I won't have known this judgment. It's very interesting, and you must note this. South Africa and Kuwait had a treaty in 2006. Dividend rate of tax is nil. 2006, Kuwait treaty rate of tax on dividend is nil. South Africa and Netherlands in 2008, it said, if after entering into the treaty in 2008, if South Africa enters into a treaty with the OECD country, giving concessions, that will apply to us. I repeat, Netherlands Treaty of 2008 at the usual MFN clause. If subsequent treaty with the OECD country is there, giving greater benefit, that will apply to us. And Netherlands Treaty said 5%. Subsequently, South Africa entered a treaty with Sweden and dividend rate of tax of 10%. Repeat, Sweden's South Africa treaty in 2012, dividend rate of tax 10%. This also had MFN clause. But unfortunately, the South Africa-Sweden MFN clause did not say if subsequent to Sweden they enter into a treaty, then I will give you the benefit of MFN clause. So party argued between South Africa and Sweden, rate of tax is 10%, but South Africa-Kuwait treaty rate is 0. Therefore, automatically, South Africa-Sweden becomes nil. Because South Africa was not careful in writing the South Africa-Sweden treaty that if you subsequently enter into a treaty giving benefit to another country, that will apply to us. If it simply says, if in any treaty benefit is given, therefore, South Africa-Sweden treaty was read with South Africa-Kuwait treaty. And so Sweden becomes 0. That's not enough. The Netherlands will have now said, South Africa and Netherlands no doubt says, subsequent to this, if you enter into a treaty, you entered into a treaty with Sweden in 2012. Sweden becomes 0 because of MFN with Kuwait. Therefore, I'll also become 0. South African Supreme Court accepted it. Similarly, the counterparty Netherlands also took the same contention. And so Netherlands, everybody decided up to the Supreme Court decided in Assisi's favor. So this is an example of how you can invoke not only one treaty with one MFN clause, you can invoke MFN clause string of treaties and you may get benefit sometimes. Okay. This is all I wanted to say, sir. Thank you. My apologies if I've been boring.
Not at all. Thank you. Thank you for being here and addressing the tax treaty nuances as well as the interplay of the municipal law and international law, specifically on Article 3.2 and at last the MFN related aspects. Thank you, sir. Thank you for being here. We just present a virtual moment to you, sir.
Thank you. Thank you. Thank you very much, sir.
Thank you.
Thanks for calling me, and thanks to my team, Sriram and Dinesh. They have done everything. I was only a spokesperson only for them. My special thanks to them and my IT person.
Thank you, sir.
Okay. Anything else, sir?
That's all.
Thank you. Thank you. Thanks to all of you. Namaskar. Namaskar.
With this, we have reached the end of the conference. Already TGS has provided the vote of thanks, so therefore there will not be any additional vote of thanks here. So we can have a high tea. Thank you all.